Hello, everybody. Let me see if I got this thing down. Okay, we're good. Hi, Ed Yardeni here. It's July 21st, 2025, summertime, and the living is easy. At least that's the way it's been in the stock market of late. And today we've got a nice day in the gold market. Gold is up quite a bit. Let me change my glasses here. I got my reading glasses on. There, I can see you better. Uh, Max, we got a double header here today. We got Max and Bailey here together. Notice how nature loves symmetry. I mean, they just kind of form a perfect triangle there, and they're, uh, they're good couch potato dogs. You can see they like to sleep a lot on the couch, and Max likes to be here during the conference calls, and Bailey's developing an interest in what we're saying, I guess. Anyways, they're here. The sun is here. We got a beautiful day in Long Island. I hope it's beautiful where you are. I hope you've been having a good summer. Uh, as uh, as the summer passes along here, it's really amazing how time flies when you're having fun, and we're certainly having a lot of fun in the markets. And if nothing else, it's intellectually fascinating what's going on here. Testing a lot of different theories, putting a lot of different stresses and strains on the economy, and yet the economy continues to perform remarkably well. It's been very resilient. We've gone through a lot. We've gone through a pandemic. We've gone through the tightening of monetary policy. We had an inflation surge related to supply shortages with the pandemic. The Fed responded to that with tightening. We had Russia invade Ukraine, craziness in the Middle East, which obviously isn't ending today. We got another civil war apparently breaking out in Syria again. They've got so many different factions there. It's hard to keep things quiet there. So that's still a mess. But then again, it's been a mess since biblical times. So I guess the markets have learned to tune it out and focus on other things. And I think what the market is focusing on is earnings. We're in the earnings season now. We are starting to see that the earnings reports are better than expected. I think when we started the season about a week ago, the expectations were that earnings in the second quarter will be up about 3.5%. Now that expectation is up to about 4.5%. I suspect we'll be looking at 7 to 8% once all the results are in, a doubling of what was expected, which is what happened in the first quarter. So again, this speaks to the resilience of the economy. In this case, in the face of Trump tariff turmoil, the economy is doing well and earnings are doing well. So, three cheers for U.S. corporations. They've managed to continue to do well. One of the odd things here is that analysts continue to expect that profit margins will actually increase. The forward profit margins are at an all-time record high. When you take analysts' latest weekly data on forward revenues and let's do it the other way around, forward earnings and divided by forward revenues, you get something like 13.5% on the forward profit margin was at an all-time record high. Now, there was some uh, cutting back of earnings estimates a few weeks ago, a couple of months ago, when we were sort of in the thick of all the tariff trauma. But now we've seen that earnings are starting to be raised. For earnings expectations are now going up for 2026 and 2025. And despite all this tariff turmoil, we're not seeing anything in profit margins, which is kind of odd. You would think that tariffs are basically a tax on companies that are importers. And then it's up to the companies that are importers to decide what to do with that. Do they suck it up and see their profit margin weaken? Do they pass it on to consumers with higher prices? Did they get concessions from their vendors overseas? And you would think, when all things are considered, there's going to be some impact on profit margins, but that doesn't seem to be the case so far. So maybe they're missing something. Maybe I'm missing something. I guess to be consistent with our roaring 2020 scenario, it may very well be that the productivity situation is so strong that that's absorbing the shock of these tariffs. Of course, we don't even really know what the ultimate shock is. I guess we'll know on August 1st what the final deal is in terms of reciprocal tariffs. But it certainly looks as though the president kind of liked the revenues that are coming in with a 10% across the board tariff, with a few other tariffs here and there for steel, for aluminum, for cars, etc. But he's kind of pleased with how that's bringing in revenues. And I guess he still believes that foreigners are paying this, which doesn't make much sense. But so far, you can't say that it's really had much impact on price inflation. So it may very well be that the productivity story is stronger than even we thought. And as you know, we've been kind of leading the way here with the roaring 2020s being led by high technology boosting productivity. So we'll see how that's playing out. Maybe it's turning out that AI is a much more powerful technology than anybody gives it credit for. We are seeing that at least the technology companies eliminating some of their payroll employees, presumably because they're using their very own AI technologies to increase their productivity. But this is a unfolding story. We'll see how it continues to unfold. But the earnings story looks pretty good. It looks as though analysts are hanging tough with their $300 per share earnings for next year. Now, as you know, when we do PE times Z, we look at forward earnings and try to assess where it might be at the point where we want to kind of forecast the market. So obviously, we want to forecast where the market's going to be at year end. And the analysts are thinking $300 a share next year. And we're thinking that that'll be forward earnings at the end of this year. In other words, analysts will be predicting $300 a share next year at the end of this year. So what multiple do you want to put on it? Put on a 22 multiple, which is where we are right now, and you get 6,600 on the S&P 500. Could the multiple go higher? It sure could. I mean, I guess we're looking at a 29, 28, 28, 29 multiple on the Magnificent Seven. They've been up as high as 30. Maybe they'll get excited again about what these companies are able to achieve. We've got a 19 forward PE on the S&P 493. Maybe they'll go higher on the expectations that maybe we're not going to have a recession for a while. The market's been spooked by recession scares for the past almost, well, 3.5 years, going on 4 years. And the markets maybe is coming around to the conclusion that we've had that maybe we're not going to have a recession anytime soon. Maybe the economy, as resilience will continue to shine through, in which case the longer that you think it'll be before there's a recession, the higher the PE you're going to be willing to pay, because you got more time for the growth to grow, for earnings to grow into the PE. So that's one kind of hypothesis of why the PE has remarkably bounced right back to where it was before the correction. The correction was obviously related to fears that the tariffs might cause a recession. Well, those fears seem to have abated pretty quickly. It was also related to the DeepSeek scare, where suddenly there was worries that maybe AI can be produced a lot more cheaply than was indicated by the capital spending of the major US AI companies. And yet, during their first quarter earnings reports, they've said, no, we're going to stick with our spending because we think it's going to be justified and we think we're going to get a decent return on it. And so the market's bought into that. And here we are at new highs in the market, led by new highs in technologies, semiconductors, NVIDIA. Happy days are here again. So that's where we are now. Of course, there's still plenty to worry about. We could have a recession. Maybe the next round of tariffs on August 1st will finally give everybody the numbers they need to conclude what to do with their businesses, what to do with what they are spending money on, and maybe there'll be a lot of retrenchment. I don't think so. What else could happen? Well, the dollar is weak again today, and gold is very strong. I couldn't quite figure it out because right before I get on, I like to check the markets just to make sure I'm not missing anything. And apparently Scott Bessent is out there. At least he was on a CNBC post saying that he thinks the entire Fed system needs to be uh, kind of rethought. Maybe we need to create a whole new system, which is a really kooky, crazy idea, but it's out there, and it's another indication of the attack on the Fed. I think most people have kind of gotten comfortable with the Fed. It makes mistakes certainly, but it's very much integrated into the economic system. It has developed a lot of credibility in the financial markets, as we saw just last week when there were rumors around or unsubstantiated reports, actually substantiated reports, that Trump told a bunch of Republicans, asked them, "Do you think I should get rid of Powell?" And he claimed a lot of them said yes. And then there was some reports that he was going to go ahead and fire Powell. And then what was it? A few hours later, he said, no, 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 he's not going to do that. And then there was a report that Bessent convinced uh, the president not to fire Powell. And then the president came back and said he doesn't need anybody to tell him what to do or what to think. He tells them what to think. And so he took the position that he came up with it all by himself, not to fire Powell. Well, we'll see what happens next in this soap opera of the administration versus the Fed. I think Powell is giving a speech today. May be happening right now for all I know. But I think he'll once again do his yada yada yada. But I'm expecting that Powell and the FOMC may start to signal a more dovish stance when it comes to September. Um, they may be more open-minded. The inflation news hasn't been really that bad. PPI was better than expected, though it does not include tariffs. CPI is kind of arguable. There were some indications the tariffs were having some impact, but it wasn't so bad. Inflationary expectations seem to be coming down. And the economy is looking fine, but they could look at the ADP report. They could look at the work week. I mean, it wouldn't be hard to make the case that if the next batch of economic indicators looks weak and inflation still looks moderate, then a 25 basis point cut in September would be possible, would be on the table. So I think they might be leaning in that direction. I'll tell you why. I think it's mostly because Powell doesn't want to have dissenters. He doesn't need Waller and Bowman to be the dissenters. So if he can tell them, look, we'll soften the tone up and we'll seriously consider a rate cut in September, then maybe he'll get a unanimous vote on the FOMC. Under the circumstances, he needs that. And I don't think he'd want to see two dissents, let alone more than that. So that's my thinking of what the Fed's going to do. Meanwhile, I think the economy is resilient. I think inflation is going to show a little bit more tariff impact up ahead here. My new shtick on the tariffs isn't that they're going to raise inflation, but they're going to keep us from getting to the 2% inflation target as rapidly as we might have been able to had it not been for the tariffs. So we're going to stick around 3% on a CPI basis, maybe a little less than that on a PCED basis, but we're not going to get to 2%, and mostly because of the tariffs, maybe to some extent because of the weaker dollar. There's also obviously concerns that the dollar is going to tank here. And this week we pointed out that that's an interesting theory. The only problem is the data through May. Maybe things changed in June and July, but the data through May showed that foreigners were still buying US Treasuries at a ferocious pace. They were buying not at a record pace, but they can continue to buy Treasuries. And the amazing thing is they bought US equities at a record pace on a 12-month basis, and a lot of that was actually in May. So once the president postponed and kind of backed off on his tariff war in April, we did see a tremendous amount of buying by foreigners. So they still like us. Maybe they even love us. Maybe they still say, well, there's the macro and then there's the micro. There's companies we follow, and the American companies we follow are doing extremely well. And if we don't have a recession risk, maybe we want to be in these companies if we got out of them, or maybe we want to add to them. And domestic investors are obviously thinking the same thing. So I'm not seeing any cues on the Q&A. So I hope I didn't forget to turn on a switch here at some point. Would somebody just let me know that I am getting across to you folks? Wow, great. Thanks, Chip. Okay, I always get a little bit uh, concerned when in the sound of silence on the system here. But we do actually have a really nice turnout again, so I appreciate your interest. And speaking of interest, Max and Bailey remain as interested as they were at the start of our call here. But let's move on. Let's go and look at some fun charts. I think they're fun, but then again, I'm a chart kind of guy, so not everybody is. But we try to keep our charts simple. I see some of our competitors' charts, and I can't even figure them out, or I figure it would take me half an hour to understand what they're getting at. So we try to make our charts uh, kind of speak for themselves. I think this figure one kind of speaks for itself. This is a nice little oval around what the bond yield has been doing, running around 4.5%, plus minus 4 to 5% for the past couple of years. And we've been saying all along here that the bond yield going up isn't just the Fed tightening, it's also the Fed normalizing. It's allowing the bond market to have its own view of where the yield should be relative to the fundamentals. And the economy is doing fine here with this rate. If the economy wasn't doing this fine, the bond market would adjust, but it isn't doing that. And it's kind of consistent where for a few years we had been in the bond market before the great financial crisis and the great virus crisis led to this aberration in bond yields. This was the aberration. This is not the aberration. These rates are kind of where they should be. I know I'm speaking in macroeconomic terms, and I've gotten feedback from people saying, well, that's easy for you to say, but my kids are trying to get a mortgage and they can't get a mortgage that they can afford, and down payments are too high and all that. So it's, excuse me for kind of generalizing, but as a general proposition, bond yields are where they should be. And it is a market, and I respect markets, and you have to have a pretty good explanation of why uh, you disagree with the markets. In this case, there was a very good explanation, and that is, and I said it over and over again, the bond market was rigged. The bond vigilantes couldn't express an opinion because of quantitative easing. Anyways, let's move on here. So meanwhile, for all the angst and anxieties and uh, uh, fears of recessions and debt crises and all sorts of other calamities. Well, we did see that tariffs combined with DeepSeek and maybe some concerns about debt crises and things like that did create a significant correction in the stock market, but it was a correction. It was not a bear market. And now we're at a record high. This, I think, is a 26%, 27% rebound in the S&P 500 in a very short period of time. And I believe it's unprecedented to have that kind of V-shaped recovery. I've been thinking last week, I was thinking maybe we do a square root here and kind of go flat and then we go up. But I don't know. I'm not quite, I'm not pounding the table on the square root idea. It may continue to be a V, especially if the Fed next week sounds more dovish, suggesting that the scenario I just laid out, Trump, that Powell wants a unanimous decision, and he doesn't want to drop rates here in July because he signaled that he's not going to do it. The markets don't expect it, but the markets do expect a rate cut in July. So why not accommodate the market's mood by being somewhat dovish and then getting a unanimous decision by the FOMC? This is a big controversy here. We've been hanging on to the idea that notwithstanding what we still think is a correction, about 8 to 10%, I think it's 8% year to date, 10% from this peak. We're expecting this to hold. And we're not technicians, but but these lines do kind of provide some assessment of the way the market and investors and professional chart players play the game. And so we play the game with them, but we also focus on the fundamentals. And we still believe that the dollar's got a lot going for it. And the point of the morning briefing today is to show that foreigners agree. For all the talk about how Trump is annoying them and unsettling them and forcing them to move out of the dollar and go to gold and go to Europe. I mean, gold is up and European markets are up, but so is the U.S. stock market. And you can see here, and the bond market's hanging in there pretty nicely. So you can see private and official net capital inflows. That data came out last week through May, and it was a blow-away number. It was an all-time record high of almost $1.8 trillion. And a good chunk of that actually came in latest month. When you do 12 months, you always have to kind of assess, well, how much of it is kind of because the back end suddenly got more weight versus the front end. And the answer is both are doing well. We're doing well. This is private. Private, again, all-time record high of $1.7 trillion. Official, they're not interested in our securities. Well, that's fine if the private reflect all the doom and gloom of people like Ray Dalio of why you shouldn't be in the dollar, but private foreign investors want to be in the dollar. I can live with that. This is U.S. bonds, not all-time record high, but nothing wrong with $900 billion over the past 12 months. That's a significant chunk of the financing of the federal deficit. I think the federal deficit is running around $1.5 trillion. So that is significant. It's down from where it had been, but still strong. And this is the mind-boggling one, is how the equities just have soared. $600 billion over the past 12 months. This is the dissection of the bonds, Treasury bonds, 541 billion. I'm sorry, I made a mistake here. When I said 900 is financing the deficit, that's not correct. This is total bonds. They actually financed $500 billion. So let's say they financed a third of the deficit. That's still significant. Government agencies and domestic corporate bonds kind of in line with what they've been buying all along. No panic to get out of the dollar and therefore get out of all bonds. This is total private and official purchases of Treasury notes and bonds. I'll pass on that. It just shows that foreigners, private foreigners bought Treasury notes and bonds. It's not just Treasury bills. And you can look at this in your spare time if you're inclined just to get more granularity on the 12-month change in flows. This is the Treasury bill flows, and you can see it's not at a record high. This is the total, but the total was like over $330 billion, and that's comparable to what we had right after the lockdowns. Obviously consistent with what we get during crises when we had the great financial crisis. So Trump's tariff turmoil created, you can see the turmoil in the buying of Treasury bills, but we haven't had the calamity that we had with the pandemic or with the great financial crisis. This is foreign holders of US Treasuries grand total. So the grand total is not too shabby. They own a record $9 trillion of U.S. Treasuries. Private officials own $5 trillion. Notice that they have not been net buyers. So I guess this would be consistent with the notion that they're diversifying into gold and other currencies. But again, the private sector's more than made up for it. And This is another slice and dice of the very same data. This is $1 trillion, grand total $9 trillion, private foreign 5.1 trillion, 3.9, and you can see that private foreign crossed above official back here. I think it was 2023. This is what officials are doing. You can look at it on your own. Ditto with that. This is Fed data that is based on the Treasury data. The Treasury data is monthly. The Fed data is quarterly. This is the rest of the world. They owned $9 trillion, consistent with what we're looking at. Others, 4 trillion. Institutional investors, 4 trillion. Monetary authority, the Fed, almost 4 trillion. Money market funds, treasuries, obviously, treasury bills, almost 3 trillion. Household sector, 3 trillion. And banks, 1.5 trillion. So the rest of the world matters, and the rest of the world still likes us. This is as a percent of total. So again, 31% is what 32% is the rest of the world ownership of total marketable securities of the U.S. And this is kind of a more historical view. Used to be that the banks were the big financiers of the U.S. Marketable debt. You can see that this is foreigners when Nixon closed the gold window, basically went on the dollar standard. Central banks couldn't convert their dollars into gold, so they held onto their dollars. We had another increase in the dollar's popularity with foreigners, and now they've cooled off to it, but it's still a significant amount of financing. So I think we covered a lot of ground. Why don't we open it up to some questions here? Quick discussion. Okay, William, the reasons for analysts' future earnings growth seems to be a bit speculative. Given all the uncertainties, would you not expect them to be a bit more cautious? Well, analysts usually start out optimistic the further out they are from where they're expected to be projecting. And as we get closer and closer, they tend to become more cautious. We see that over and over again. I don't see anything different in the way they're looking at things. But yeah, I mean, they're not looking at it as economists. They're obviously talking to their companies, and they're getting some pretty good feedback that that they should no longer be cutting their estimates. They were pretty aggressively cutting their estimates over the past few months, and just in the recent weeks, they've stopped doing that, which suggests that between what the companies are telling them and maybe what they're picking up in the newspapers or on CNBC or whatever, or listening to talking heads like me, they've concluded, there goes Max, he's had enough. Yeah, I'm not particularly concerned that they're overly optimistic, but maybe that's because I'm overly optimistic and I share their optimism about 2026. Roaring 2020s, right? Chip, what you just said about it being somewhat crazy that Scott Bessent would rethink the Fed as an entity, why is this not a worthy thought with the Fed losing $1 trillion in their holdings and a burn rate that is presently untenable? I guess my thinking is you don't want to turn the Fed into a political football, which is what the administration seems to be doing. And with this kind of discussion of like, let's reconsider the entire Fed. I mean, who's gonna kind of put together the new Fed? The original Fed was actually put together in secret by some of Wall Street's financiers on something called Jackal Island, and they were bankers, and I think they came up with a system that was meant to have a lot of checks and balances in it. I think where the Fed went wrong is that the founders forgot to limit the impact of economists on the Fed. It's when economists really took over the Fed from lawyers and bankers who tended to be fairly conservative that we really got into trouble with the Fed. So it's opening up a can of worms, and it creates an enormous amount of instability. So I don't think the Fed is ideal, but It's the second optimal choice, in my humble opinion, given the chaos that would occur if we suddenly re-examine the whole shooting match. How do you get Democrats and Republicans in the same room to come up with a new structure for the Fed? I do kind of like the idea of markets running monetary policy. Um, what I really like is I've offered to run monetary policy on my own for half the price of what the Fed charges, and I think I could come up with policies that are kind of consistent with what the Fed has done, and hopefully done somewhat better than they've done. But anyhow, so let's move on. Lee, thoughts? Tariffs have not impacted pricing or consumption yet because A, stockpile products, B, transshipping, C, creative identification of products to avoid tariffs, D, absorption by foreign producers based on dollar value dropping. All good points, Lee. You've thought about it clearly, and you got a good list there. Um, yeah, my thinking is that my thinking has evolved on that. Maybe we're not going to see tariffs increase inflation, but what we're seeing is that tariffs have gotten in the way of inflation getting down to 2%. Maybe tariffs are going to keep inflation closer to 3% for longer, for a while longer, maybe several months longer than would otherwise have been the case. If there were no tariffs, we probably would be at 2% now. So that's kind of what my thinking is. And my thinking is still that there's no reason for the Fed to lower rates if the economy continues to perform well, which it is. And if inflation is kind of stuck at 3% for a while, what's the rush to lower interest rates? And I guess my other concern is I love a bull market. I'm bullish. I think we're in the roaring 20s. I think we're going to 10,000 by the end of the decade. I just don't want to get there by the end of the year. I don't want to melt up. Melt ups lead to meltdowns. I think we kind of just experienced that it wasn't very pleasant to see the market hit a record high on February 19th and then take a dive through April 8th. And then we had to live through all that commotion. And here we are at a record high. But hey, that's the nature of our business. So maybe we shouldn't complain. We should just, it is what it is, and we deal with it, which has kind of been my underlying approach to this business. I think a couple more questions. Lee has another one. The greatest impediment to a Fed rate drop is President Trump. The more he tries to influence the Fed, the more Powell tries to prove he cannot be influenced. I think there's a good point there, but I think practically speaking, Powell doesn't want to come out of the July FOMC meeting with two dissenters, Bauman and Waller. So I think he's going to have to give him something, and that's a more dovish tone. Uh, and that'll kind of allow him to play it both ways. If the data comes out confirming that things are slowing and that there's no real impact of tariffs on inflation, he can go for a September rate cut. Market's expecting it. There wouldn't be any shocks. The president would say, "See, he's too late, but at least they're coming around to my point." So it gives Trump some victory. So, this is a touchy situation. Let's put it that way. Uh, let's see. Brad, would you increase equity allocation to the international, developed, and/or emerging? No, or what? No, I'm still recommending overweighting the U.S., but that doesn't mean not owning, having some weight in the rest of the world. It's actually pretty easy to overweight the rest of the world since the U.S. accounts for 70% of the market cap. So overweighting the international side, if you go to 35, 40%, you're overweighting. I don't really have a problem with that. You've still got a lot in the U.S. I don't know. There's still a few of you out there. Let me finish up here with Brad. Would you oh, that was Brad. So let's go to Jackal Island. Jackal Island is beautiful if looking for a quiet historic place to get away. Nice to know. Any of you in technology reporting in U.S., when will market care about return on invested capital of tech spending in AI. The market doesn't really have a clue what the ROIC is going to be on AI. And for now, it's just hoping for the best. We still can't rule out AI may have more hype than reality in it. But for now, let's stick with what the market's telling us, and that is that it's real and that it can have an impact. And look, it is working in autonomous vehicles. That thing's spreading. I think that software is AI. It's starting to work in robotics. So I think there's reality there. On that hopeful note, let me thank you for joining me. Let's do this again next week. All the best.